We have a question here from Kerrick asking about the US session. He asks whether we should expect pullbacks during the US session instead of thinking the market will continue with the overall intraday bias from the prior sessions. Now, thanks for the question, Kerrick. It is an important one, especially if you're trading during the US session, which I assume that you're doing. Now, there is a couple of things we can say about the difference between trading sessions. And the first one we should always consider is just the overall sentiment. So, if the sentiment that's driving the markets on an intraday basis is strong enough, there shouldn't be any reason for the markets to have an abrupt reversal and pullback during the US session. But that won't necessarily stop the market from taking a breather and pulling back from one session to the next, um, even though the sentiment might be present. Now, something that can also make a difference is the type of news that hits the market. So, if the news has a strong influence on European equities, but not necessarily on US equities, you might have an increased probability of seeing the market change course during the US session. But it will be very tricky to put it down to an exact reason if there's no real fundamental news flow or specific catalyst that changes the bias. The other thing to keep in mind is that pullbacks is something that will happen. Whether it's during the Asia Pac or European or North American trading session, pullbacks is something that will always happen. And even though we can look for higher probability places on the charts where we can expect a pullback from, there is obviously no guarantee that it will happen regardless of the trading session. Now, in the current context where we are trading in here right now in July 2020, there is something very interesting. And a recent article by Morgan Stanley, it's a very interesting read and might explain some of the frequent US session pullbacks that you're referring to in your question. There's an extract from the Morgan Stanley note, and I'll read it to you. It says, one of the characteristics of the US equity rally over the past 4 months has been the divergence between the performance during regular market hours and extended market hours or after hours and pre-market trading. While up until the end of March there was little divergence, since April all of the S&P 500 up moves appear to have happened during extended market hours, while regular trading hours have on average acted as a small drag. Now, this occurrence was actually first noted by a couple of articles from zerohedge.com, where they highlighted the vast difference between the cash and extended hours trading performance. And if we look at this chart on the screen that they had on that article, we can see the difference between the day session and the overnight session for the S&P. And according to them, the S&P has lost 5 points during the day session, while the overnight session on average has gained about 319 points. So it's just a massive gain. And they highlighted in the article that if a trader bought the cash open and sold the cash, or bought the cash close and sold the cash open, they would have generated roughly a 40% annualized return just by doing that, which is staggering. Now, digging into some of the trends in the article, they noted that European equities made most of their gains during the US cash session, while the US equities made most of their gains during the European cash session. Now, there's many speculative reasons given for that, with some pointing to the possibility of central banks actually choosing to buy when markets are sleeping. But according to the Morgan Stanley note, there is, however, a less conspiracy-based theory phenomenon to explain that, and saying that the biggest market moving drivers recently has occurred after US cash hours or before US cash hours. And this will include important market updates about vaccines, things like important European and Chinese PMIs, which has been big market movers. Also keep in mind, that the very important US data, such as NFP, retail sales, jobless claims, etc., they're all released just before the US cash open. So according to the Morgan Stanley note, these gains during aftermarket or extended hours can be explained by data flow for the most part. Now, according to Zero Hedge, their view is that central banks are using the aftermarket hours to basically prop up the markets, which is a view shared by many other analysts as well. So whether it's a conspiracy reason or whether it's a news-driven reason, the point is that there has been a divergence recently to take note of, which is probably what you've been noticing as well. And whether this divergence is something you should consider trading, I mean, that's entirely up to every trader's own discretion. Being in front of the screen every single day during the European trading session, I tend to agree that the flows has been very heavy. The news flows has been very heavy during the European trading session compared to the US session, which would explain the big moves during the European session, and then followed by some pullbacks during the New York trading session. Now, the thing about reading reading too much into studies like this is that this trend can change tomorrow, can change today, for any number of reasons, which is why I would be careful of reading too much into stuff like that. But of course, it is valuable knowing that these types of divergences are occurring, and is probably what you've been seeing in the market as well. So I hope that the article, that this chart and the notes from Morgan Stanley and Zero Hedge has been helpful here, Kerrick. Any other questions, please don't hesitate to let us know.